Okay, so we can now turn to problem 7 and handout number 9, and we're going to deal with this one at a very high level, just straight by way of lecture. Since this is not something that you're going to encounter in the real world, this is not only because it's not only because the accounting software would just solve this problem for you. So like as a lawyer, you're just never going to get asked about this because it's all going to work itself out internally and the accountants will never think about it. But also because this problem sort of supposes that there's active business being carried on by the Canadian resident corporation outside of Canada, which only in very rare circumstances will that actually happen at all. Normally, if you're going to have a business carried on outside of Canada, it's just going to be carried on by a controlled foreign affiliate in the foreign jurisdiction anyway. So that's fairly unusual. So, if we're going to talk about paragraph 125(1)(b), which is what problem 7 is really concerned about, we're going to be talking about paragraph 125(1)(b) in the context of things like non-capital losses or losses from other sources. We're not going to be super fussed about paragraph 125(1)(b) because we have foreign income and foreign tax credits that we have to worry about. So what problem 7 wants you to do is it wants you to apply paragraphs 125(1)(a) and (b) together to determine which is going to form the upper limit on the small business deduction in this instance. So you'll of course recall from a mere hour and a half or so ago that the small business deduction limit is basically the lesser of paragraphs 125(1)(a), (b), and (c). And that paragraph 125(1)(a) is effectively the income of the partnership from the income of the corporation from its active business carried on in Canada. Paragraph 125(1)(b) is effectively its taxable income, and paragraph 125(1)(c) is the business limit, which is generally $500,000 unless otherwise reduced. So, in this example that we have in problem 7. We know that there's only $100,000 of income from an active business carried on in Canada. So we know that that's the paragraph 125(1)(a) amount. And so we know since that's less than $500,000, the lesser of A and C is going to be A at $100,000. And so paragraph 125(1)(b) can only serve to further reduce the amount of the small business deduction eligible income to something that's less than $100,000. So in order to deal with paragraph 125(1)(b), you need to calculate taxable income. And so the way you would do that is you would add the Canadian business income, foreign business income, Canadian investment income, and the foreign investment income. And then you'll ignore all the credits, but you'll subtract the non-capital losses carried forward. And that gets you to taxable income. Then what you need to do after you've done that is now the credits come into place. Now you've figured out your taxable income otherwise determined. You can figure out your paragraph, your specific paragraph 125(1)(b) amount, which is taken by grossing up the presumed foreign tax credit for foreign passive income. Subparagraph 2 is the presumed grossed up foreign tax credit from business income, foreign business income. And subparagraph 3 is just the exempt. Whatever income of the corporation is tax exempt for some reason is going to be dealt with in subparagraph 3. So that's it. That's what it's trying to make you do. I don't think I've actually calculated out what the number is supposed to be, but that's it. And again, just it's not something you need to really worry about, like what the actual numerical answer is. Again, because in the real world, accountants will just solve that problem for you by punching all the numbers into tax prep software. But do know that it's there, and do know that you cannot have more small business deduction eligible income than you have taxable income, basically. So with that, we can move to slide 21. And slide 21 is new. And it's again, this is another one of the 2016 amendments where it's not really dealt with in the handouts at all. It's not really dealt with in the handouts at all because it's, again, another one of these complicated things that you really have to understand. In order to really understand how the specified corporate income concept works, you really have to understand how all of the small business deduction related pieces fit together. And, obviously we're not there yet. So it's one of those things it's very hard to break down in a way that's comprehensible. But basically, the specified corporate income concept, it is very conceptually similar to the specified partnership income concept. So again, to use an example of how this would have worked in the real world, and what we were trying to prevent in the real world. Suppose that you had a group of doctors who were carrying on a business through a clinic, and the clinic was organized as a single professional corporation. So obviously, if that single professional corporation has has taxable income, it's going to get a single small business deduction for $500,000. But what would actually happen is that all the doctors would own the shares of that professional corporation personally, but they would also incorporate a second professional corporation again, which would bill the head PC for the services actually rendered by the doctors. And since that second PC would not be associated with the head PC, because generally nobody had a large enough interest in the head PC, and nobody was related. And again, we'll talk about association next week, but they weren't associated, so they didn't have to share the business limit. So every doctor, by feeing their income basically out of head PC into their side PC, got a full small business deduction, even though there was only a single clinic business. And so that's what specified corporate income is intended to prevent. So it basically applies where you have income that's described in the specified corporate income definition, where you have income that is somebody's popping in here. Let's let them in. So it basically arises where you have a private corporation that's paying amounts to another corporation with which it is not associated, and the payee corporation does not deal at arm's length with a person who directly or indirectly has an interest in the payer corporation effectively. And if that happens, then the income is described in the definition of specified corporate income, and you only get to have actual specified corporation that gets added to the small business deduction base to the extent that the payer corporation allocates part or all of its small business deduction to the particular payment. So extremely conceptually similar to specified partnership income and what it's trying to do. That it's trying to prevent multiplication of the small business deduction by having multiple people receive payments from the entity that would otherwise be constrained to a single small business deduction. So that's there again. So if we just go to the next slide, which is slide 22, we can see the requirements on the slide. So basically, at any point in the year, the corporation or one of its shareholders holds an interest in the other private corporation, which is the payer corporation. And the corporation, in this case, this is the payee corporation, derives more than 10% of its income for the year from non-arm's length parties. So basically, if you have 90% or more of your income from arm's length parties, you don't have to worry about specified corporate income. But typically, in these situations, that would not be the case. And so the result, like I said, is that you only get small business deduction eligible specified corporate income to the extent that the payer corporation in that situation allocates its business limit for the year to the payee corporation. And it can in fact do that even though they're not associated, which is there's a separate form that goes to the T2 that allows you to allocate your specified partnership business, your specified corporate business limit without having to be associated. So that is the magic with specified corporate income. We're not going to talk about that very much. We're going to largely pretend it doesn't exist for the purposes of this course, just because there's a lot of nuance and a lot of complicated rules. If you want to see again how the new specified partnership income and specified corporate income rules work, there are a number of papers describing that in TaxFind, which I know you have access to through the U of A library. So that might be worth a look if you want to see how those rules work. But we're not going to talk about them again, and we're just going to pretend they're not there for the balance of the course. So then we can move on to slide 23, which is our last slide in this deck. And again, with slide 23, we have what's in the handouts at part 8 of handout 9, but there's also a new addition here as well that we will talk about, but just hasn't been worked into it. Where again, it's not going to make a lot of sense right now because you don't know how investment income works just yet, which is relatively important in understanding how the new stuff works. But we'll talk first about the original, the OG subsection 125.5.1, which is now paragraph 125.5.1a, and how that works. And then we'll talk about what's new and not in the handouts. So paragraph 125.5.1a effectively provides for a reduction to the small business deduction limit to an amount determined by a formula. And effectively the reduction under paragraph 125.1a, 125.5.1a is 10 cents reduction to the business limit for every dollar that the corporation's taxable income in its preceding taxation year, taxable capital in its preceding taxation year exceeds $10 million. So at this rate of reduction, the business limit is ground to zero at the point where the corporation's taxable capital in its preceding taxation year exceeds $15 million. So that's well and good, sounds relatively straightforward so far. Then we have to take account of associated groups. So if the corporation was a member of an associated group in the preceding year and not in the particular taxation year, then it's the corporation's taxable capital for the particular taxation year that's used for the purposes of the subsection paragraph 125.5.1a formula. If the corporation is a member of an associated group in the particular year and the preceding year, then it is the taxable capital of the associated group in the preceding taxation year that gets used to determine the grind. And so, as you've probably guessed when we start talking about the word capital, the purpose of this provision is effectively to make sure that associated groups that are entitled to the small business deduction have some requisite degree of smallness about them. The cutoffs for $10 million and $15 million of taxable capital as the point where that cutoff occurs is completely arbitrary. There's no rationale for that. And again, you can have instances where people that you think should get the small business deduction, just don't, because their business is so capital intensive that they have, they'll be over $10 million of taxable capital very easily. So as an example of this, think of a car dealer, or basically any kind of equipment dealer, right? Where if they have to do floor plan financing, similar to what a car dealership would do, that's going to count against their taxable capital. And any reasonable car dealership that's an affiliate of an automaker is going to have way more than $10 million of floor plan financing at any point in time. And effectively, no one in that world is going to get a small business deduction as a result, because there's going to be well over the $15 million complete grind point. So it's the kind of thing that can trip you up. So then what is taxable capital? So the place you want to look for that is subsections 181.2, 2, 3, and 4. And these were provisions that were initially enacted for the purpose of what was formerly the large corporations tax, which basically applied to to include as a tax a percentage of a large corporation's taxable capital, and the large corporation definition was basically like taxable capital in excess of, I believe it was $50 million. We repealed the large corporations tax in like 2003, but we kept the framework in the act because the taxable capital framework gets used for the purposes of the small business deduction grind and for some other purposes as well. So it's still, the framework is still there, even though the actual tax has been repealed. But the actual, when you go through those provisions, what you'll see is taxable capital is basically the excess of capital over an investment allowance. And the amounts are based on the corporation's IFRS and or PE GAAP financial statements, depending on which set of accounting rules the corporation follows. It's purely determined by looking at the financial statements. And so capital is basically balance sheet share capital, retained earnings, non-deductible reserves, debts, and unpaid dividends. And then the investment allowance is basically shares, debts, unpaid dividends of another corporation, and some portion of the value of a partnership interest, effectively based on the underlying investment in the partnership. So that net number is taxable capital. There is a distinction between taxable capital and taxable capital employed in Canada, but again, in this course, we're assuming everything is done in Canada, then we don't care. But that's effectively how that works. So if you have a very capital intensive business, you expect that your small business deduction is going to be ground. And if your taxable capital employed in Canada exceeds $15 million, you get zero small business deduction as a result of paragraph 125.5.1a. So that brings us to the new thing. And the new thing is paragraph 125.5.1b. And what paragraph 125.5.1b does is it provides for a different grind to the corporation's business limit. And this one isn't based on taxable capital. It's based on a different concept called adjusted aggregate investment income, or AAII. And basically what AAII is it's the corporation's aggregate investment income, which we're going to talk about when we talk about the taxation of investment income. So it's aggregate investment income, but you have to add some things back into it. So for example, any FAPI income from a foreign affiliate, after taking out the subsection 91.4 deduction in relation to that amount, gets added into adjusted aggregate investment income. Amounts received under imputed or otherwise from a life insurance policy get added in to AAII. Things like that, backing out capital gains on an active asset which is basically a share, for example, an asset used principally in carrying on an active business in Canada, or a share of a corporation that is a small business corporation, etc. So items like that, but basically adjusted aggregate investment income before we get to the adjustments is the corporation's income from property or a specified investment business, essentially, and then adjusted aggregate investment income just makes those adjustments. And so the way the grind works is that if the corporation has adjusted aggregate investment income over $50,000 in the taxation year, then paragraph 125 5.1b will grind the small business deduction limit. And by the time you hit $100,000 of adjusted aggregate investment income in the year, then the business limit is ground to zero, effectively. So that's how it works. So again, instead of being based on capital now, it's based on the return on effectively passive assets. So in the form of foreign source dividends, capital gains, interest, rents, royalties, etc. Once you get over $50,000 a year, you start to grind the business limit. So that is relatively new, and that one matters quite a bit in real life as well. That effectively everybody who had been, especially for professionals, everybody who had been building up large stocks of investment assets in their professional corporations, they're all, they either had to do something to extract the assets, or they've had their small business deduction ground as a result of earning too much investment income in a particular year. There's various ways that people have tried to get around that. For example, just by shifting your asset portfolio into non-income producing assets, like shares of tech companies, etc., in order to avoid dividend income, and then just holding to avoid capital gain, stuff like that. But yeah, that is the new constraint on the small business deduction, and that explanation will make more sense once we see how aggregate investment income works generally. Then you'll understand how adjusted aggregate investment income works. But again, if you want to take a look at that, the definition of adjusted aggregate investment income is in subsection 125.7. There's a separate definition of active asset in subsection 125.7, and you can feed that back into paragraph 125 5.1b. So that's all we had on deck 3. Did anybody have any questions about anything that we've talked about today? Okay, I am seeing none. We have 16 minutes left today. I do not think there is much point in starting on deck 4 with 16 minutes left. So if there are no questions, we can go enjoy our weekends or not enjoy our weekends, however we want to do that. So I'm going to stop recording. And there we go. Stop recording.